This is our agenda, what we're going to talk about today, some fundamentals of LLCs, what they're all about and their formation and maintenance, some very important tax matters that almost all clients do not know about, the wonderful flexibility of LLCs. Prop 19, a very important cash refund of employee payroll tax that you have paid. Beware of internet forms and programs. Some case studies on LLCs gone right or gone wrong, and how we can help. So, what is a limited liability company? It's the most recently developed entity that arose from clients with businesses and then very small businesses realizing that a corporation wasn't really necessary and it has terrible tax disadvantages. And small businesses get sick of doing minutes every year, which they have to do, even if they have a sub S corporation. That'll be the first thing that's requested when a lawsuit is filed, their minute book. So these came into being. They are a shield that is as effective as the corporate shield if you operate it correctly. It protects you from liability to all kinds of creditors of the business and liability to litigants if they file a suit against you for negligence on not perhaps maintaining something correctly on the LLC rental property. And many say, oh, insurance can limit your exposure, which it can, and you should have liability insurance as well as property insurance. But I say, why be exposed at all if you can get a simple, extremely useful entity to do some of that work for you, perhaps not have a lawsuit even filed due to the litigant knowing they're not going to get anything from you personally, but only perhaps part of the real property sale proceeds. So I say that a lot of people are really in denial in various regards as to whether a lawsuit, a complaint, will ever be filed against them. And I've had that myself to some extent. I used to rent a room in our home to a tenant, and I didn't think I would ever get sued. I didn't, but others do. There is truly, know that there really truly is a significant risk of litigation claims in this day and age. And worse, courts have become increasingly aggressive against landlords. That's individuals who own rental property. You'll hear later in some crazy ways they've become aggressive. So I say shield your nest egg. Your nest egg involves your vehicle, your home, all your accounts and retirement plans. Shield that stuff from ever being taken to satisfy a court award. As I said, but it bears repeating, an LLC protects your nest egg as well as a corporation does, without the hassle of minutes. And now we're forming LLCs in all states, often where the real property is located if it's out of state. But in addition, some states have no income tax. That can prove a great benefit. Some states offer extreme privacy, and we can layer protection if you're really diligent on making sure no litigation matters get to your personal assets. So who should use an LLC? Starts with, as I keep saying, rental property landlords, business owners, licensed professionals, doctors and lawyers and such, consultants, which have possible professional liability claims, but also can save on their taxes by using an LLC, and independent contractors. So when should you form an LLC? This is a little of a trick question. Before there's an accident or lawsuit that puts you at risk, obviously. Afterwards, though, in all seriousness, you're not going to be able to protect yourself from an existing claim because that can bring in the fraudulent conveyance law. And ideally, before you purchase a rental property, if that's what you are going to be doing, and before your business earns a profit. So as far as forming an LLC, there are many steps, but the critical needs for where you, and why you need an attorney to help is the operating agreement. That's the agreement that you're going to live by in operating the property, whether it's just property or also a business. It's very important that it has everything you want on a custom level to live with this plan for some years. And then the deeds are critical, something you would never want to do yourself. The ancillary documents that go with the deed are what protect you from any reassessment for property tax purposes. And even if you just do it slightly wrong, some counties are going to hit you with a reassessment, which you've got to go in and have us fight. Only attorneys can fight with the Assessment Appeals Board. And I've done it a couple times now, post Prop 19. And it's a long and lengthy and amazing project that they will go back in years to see if anything else was wrong in the past. Even if, in a couple cases, I've quickly convinced them that there's nothing wrong here now in the latest deeds, but they want to make sure everything is copacetic from time immemorial. So I really suggest a qualified professional, and that does not include a CPA. That is not what they've been trained to do, is legal documents. So we do one set of minutes, organizational minutes, to set forth some of the details about who the manager is, what the provisions are for how that will change, could change in the future, and specifics to the right now. All of your policy matters are set forth there. And then an optional agreement is a buy-sell agreement, which is a magical agreement to have to really think through in advance now, before the matter gets going, what you might want to do in the future, whether you might want to leave, have an exit strategy, or another of your partners might want to. So you could get some of these things, including like the sale price, agreed up front, so there won't be any fighting later on, or heaven forbid, relatives fighting, or you fighting with the heirs of a partner as to sale provisions and when those will kick in and whether you need an appraiser or not. Can all take time and cost a lot. So a buy-sell agreement protects the entity and the operations for when things will change, and they will change, is our experience. So that's something that you often decide to implement after you've got the LLC itself formed and ready to operate. Now we are going to talk about the very important issues about choice of how your LLC is taxed from both federal and state purposes. So the first choice I want to talk about is when you are a single member LLC, how all of the income tax items and the cash items, net cash income, flow from the LLC through to the single member. And a single member, by the way, includes a single person, or just one person of a couple, or an actual couple can still own a single member LLC in community property states, because the couple is considered one member. So that simplifies their tax reporting. And you can usually use a schedule to report all the income and expense of the LLC. So that's the SM LLC, or single member LLC. Now you can choose to be taxed as a corporation, a regular C corporation, they're called. But that would be for a very special reason, because C corporations have double taxation. You're taxed both at the corporate level when you receive income and at the individual level when the cash is passed out to you as a dividend. So that's highly undesirable in most cases. Now, if you make the election to be taxed as an S corp, that is often a very good choice for an operating business. We don't see that at all for real property entities, because S corps, any corporation, does not have good provisions for real property. In fact, they're extremely bad. And you can recognize gains when there has been no cash gain. But for an operating business without real property, it can be a very, very good choice, because you can increase tax deductions by leasing property from the owners. For instance, a real property or a vehicle. And again, you can minimize unemployment tax by using that choice. But the granddaddy of the choices, the best choice, is very often a multi-member LLC being taxed as a partnership. That's where all the nuts and bolts of the tax code are, for great benefits for real property. No unexpected gains are going to be recognized when you never got the cash gain. And you can customize it so that you can allocate income and expenses to partners disproportionately if you meet the tax rules. You have to have substantial economic effect. But what I mean by allocating would be that in some cases, you might want to have some of the income taxed to a partner in a lower bracket, whereas you might want to have some of the expenses or depreciation, for instance, be able to be recognized by a partner in a higher tax bracket. So partnership taxation is often the way to go for a multi-member LLC which owns real property. Now we're going to take a side venture into a tax credit, the employee retention tax credit, which I am positive you've all heard about on the radio. And it's late in the game now, but it's beneficial to come in late in the game sometimes, because you see how the IRS is processing returns. They were brand new a year and a half ago, and now we're seeing who they're auditing and for what reasons, so we can steer clear of that. So these next 6 to 8 months are a fabulous time to file for this tax credit and to get, in many cases, a huge refund of $150,000 to $250,000 cash. So you need to qualify to get this refund. And there's some basic ways to qualify based on gross receipts decrease during COVID. But many of the businesses that still exist didn't have decreases. They came up with workarounds, so they actually had an increase in gross receipts, or not the 50% or the 20% required under the code, as I state there. So the way that we're finding the most traction is if you come within the safe harbor. That's an IRS term for you're not going to be looked at too thoroughly for purposes of audit, and can show a 10% reduction in gross receipts over one of those years at least, from 2019 to 2020 or from 2019 to 2021. And then we do a in-depth write-up showing how government orders damaged your business. Employees weren't willing to come in because they were fearful of getting sick. Employees quit. You had a situation where some of your parts were coming in from overseas, and there were severe shortages and delays. So the CDC sanitation rules can be cited. Any federal, state, or local COVID order is citable, and the port closures, which that is spelled wrong, I now see, created a lot of problems, both East and West Coast and through Houston. But if you had those problems, you know. So if you're qualified, the employer can get pretty large refunds. It's up to $5,000 per employee for 2020, up to $21,000 per employee for 2021, totaling $26,000 per employee. That's where those hundreds of thousands come from. And it's well worth your while to schedule a call with us to see if you qualify. The claim deadline is early 2024, but we will likely stop accepting requests for the return filing by December. But the sooner the later, it could get really busy near year end. And a final tax point for a very few of you perhaps is that an LLC is a beautiful entity to use for gifting of perhaps non-voting interests to your beneficiaries or to a trust for them. This allows your beneficiaries to share some of your taxes as well as perhaps some of your rental or business income. And I just want everybody to keep in mind that the gift and the state tax exemption is being cut in half at the end of 2025. So if that's one of your worries, know that acting on that worry is going to be needed sooner rather than later. And if you're going to gift, it's often a comfort to parents for them to remain in control of the operations and have the children or grandkids only be passive investors. So that's an idea for you. Now, Prop 19, which we hoped was going to get overturned, but now we don't think it's going to. How it impacts, well, how LLCs, most importantly, how LLCs can function as a workaround to the problems of the lack of the minimization of parent-child exemptions on transfers of property. So Prop 19 overturned Prop 13 and amended two main property tax rules. First, the good for seniors who can now move their home's low tax base to a new replacement home anywhere in the state. And Section 2, the bad news, and that is parent-child transfers. The exclusions from a property tax increase have been greatly diminished. The parent-child exclusion for their home, transfer of their home to a child, now has the requirement that the child must actually live in the family home. Take up residence within a year after the transfer. And for other properties, your vacation home, commercial properties of all kinds, industrial properties, that 1 million exemption based on assessed value has been completely eliminated. So that's where we're working on some workarounds for you. So real quick, those over 55 can use this seniors exemption. They move to a higher cost California home and keep their lower tax base. And they can do this up to 3 times in their lifetime. The critical thing is you must buy that new home within 2 years of when you sell your prior home. And by the way, this also applies to disabled homeowners and victims of natural disasters, like fires. So I hit this before, but once again, to use an exclusion from reassessment for the transfer of a home from parent to child, the child must occupy the property as their home. That was never a requirement before, so you could rent it out under Prop 13. So, like I said, we have a possible workaround to avoid reassessment during your lifetime, at least. I'm talking to the parents. Schedule a call with me if you'd like to discuss. So the ideal step to take is to buy new properties in an LLC, because then later you can gift all of those interests to heirs without a reassessment during your lifetime. And thereafter, in that case, after you pass away. Now, if you have an existing property LLC, we can show you how you can gift to a descendant up to 50% per descendant. No one can get more than 50% of the LLC interest. And you might hear about a multi-year transfer structure. I'm very wary of it. I'm not sure that it works. There's provisions for the assessor to get around it. So I don't like it or recommend it. Now, internet forms and internet formation programs for LLCs that might be tempting to you. However, we warn that having a non-attorney form an LLC could result in absolutely no protection, and worse yet, in tax penalties and interest. We've seen many of those come through the door and have had to correct them. So that means they lacked professional advice at the formation stage. The exposure might be discovered only when it's too late and you've already been sued. So the cost of an LLC is well worth the protection. Now, I'm going to talk about some case studies. LLCs done right and done wrong. First of all, a drunken tenant falls through a railing, which was perhaps looking like the picture on the right, just not very sturdy. So the tenant's injured pretty severely because this was on a 2nd story interior common area of a condo complex. Tenant was injured severely. Of course, he filed a lawsuit. The property owner was found to be negligent in the repair of that railing, but no LLC was created, which could have provided some very useful financial protection when it came to paying that court award. Now, this one seems sometimes too weird to be true, but it was true. Tenant had an aggressive dog. Now, what landlord did wrong is that the front door of the home that was leased didn't latch properly. So the dog escaped and traveled several blocks away and bit someone. The victim was injured, filed a lawsuit, and the landlord was found liable for the entire award. That one wasn't that big, but no LLC was there to protect, and it likely, very likely would have protected entirely on this fact scenario. Now, this is a scary one for a doctor. A patient was scheduled for surgery. During surgery, an unforeseeable injury occurred that didn't cause death, but the patient was unable to work. So they filed a lawsuit for a lifetime of lost wages. The doctor was found liable for negligence, and an improperly filed and maintained LLC was created using internet forms. It's very hard for me to believe that a doctor didn't splurge for the attorneys to help, and no protection was obtained at all. You know, I think professionals honor the work that another professional can do, but in another way, on another hand, maybe they think they're smart enough to be able to get their way through an internet formation, as opposed to hiring an attorney. Now, this is our success story. It was a slip and fall on a rental property. So a properly formed and maintained LLC was in place. A visitor to the property, to the rental property, slipped and fell, was injured, filed a lawsuit, but the owner was removed as a defendant before oral arguments even began. The LLC was held liable and had to pay, but the LLC and the LLC property was liquidated in order to pay the judgment, but the landlord's nest egg remained firm and secure, shielded by the LLC. So these things do happen. How we can help. First of all, as I said, buy new real property in an LLC. Have us help, if you wish. When you come in for a review of your estate plan, specifically mention your desire to minimize taxes and to reduce your risk exposure. We can help with both in my department. And at this point in time, I really believe businesses should consider filing for the ERTC credit to get a major cash refund. Next steps, I'm repeating a lot, sorry. Plan to shield your nest egg from negligence and business and rental liabilities. Consider forming an irrevocable trust to hold gifted LLC interests, which is another layer of protection, but it's also a huge protection against estate and gift tax. Why should you use a qualified professional? They understand the tax law and the business law. They understand specialized planning of all kinds. So they can intelligently add custom language provisions. You'll know what you need to do and how often you need to do it to keep your entity current with the state and taxing authorities. So here's where I get a brag on Kopenbarger for a while. We've been in business over 44 years. We've got attorneys with combined experience of 350 years. That's spread over 8 attorneys. We've got departments for business and tax, that's mine, estate planning, estate administration, and long-term care planning or Medi-Cal planning. We have certified specialists in probate, estate planning, and trust law. Many of us have advanced tax degrees. We have 35 plus highly qualified support staff and 8 locations. As each of you current clients I know, you've been to one of those 8 locations, or now maybe you're taking advantage of our Zoom schedule. Now I'm going to wrap up by telling you you're going to receive an automated phone call from us asking if you're interested in setting an appointment. And we'd love to hear from you. We have our team standing by, ready to assist with any questions or comments you might have. And I warmly invite you to schedule a consult with me for discussion of an LLC or other business matters. So I'm going to see if there are some questions in chat that I didn't see early enough. One of which was, can you talk louder? Oh, I am so sorry, Rakesh.
Hi, Sunny. This is David. We just have the 2 questions that still need to be answered.
Okay.
And the first question is a Prop 19 2-part question. The first half of that is, if a child lives in the home, how long does that have to be? The second part of that question is, if the home is in an LLC, can the state find out the child is not living there?
Okay, so Mrs. Dunmeyer, yes, the state is going to find out when the child is not living there. They will only get the benefit so long as they live there in your primary residence following your death. And yeah, they do find out. They've added tricky questions now to be sure that they know what's going on with that residence. And the FTB is sharing information with the Board of Equalization. That's the board that overviews property tax. So I wish I had better answers for you. I don't. Was there one more, David?
And then we have one more from Diane, and that is kind of like the same as the first part of the last question. And that's simply, how long must the child live in the home?
Well, you only get the exclusion from reassessment so long as the child lives there.
All righty. Well, that's it.
So it's a limited time period. Thank you for those questions. Okay, we're going to let you go on with your afternoon now. It's been nice speaking with you, and I hope to speak with you in the future.